Global markets are mixed ahead of Thursday's crucial vote. Let's bring in Sam Stovall, U.S. equity strategist and S&P Global Market Intelligence. Good morning, Sam.
Good morning.
All right, first up, markets. What are you watching?
Well, obviously, how can you not watch the Brexit? Yeah, I guess you can have one eye looking toward Yellen today, but I think really most of the market action, most of the market's confidence or lack thereof is a result of the upcoming vote.
Okay, so what we know right now is that we are seeing the polls shift to the UK remaining in the EU. What does that do to markets? Well,
I think that's going to be pretty positive for markets. That's our expectation, is that Britain votes to stay in the EU. I think as a result, the 2131 all-time high on the S&P 500 will act like a tractor beam pulling the market up toward it now that much of this uncertainty has been removed. And then once we get back to break even, history actually says we could move another 9.5% higher.
Okay, and you just used that word uncertainty, and at the last news conference held by Janet Yellen, when they decided to leave interest rates at this historic low, she used the word uncertainty in some form like 13 times, I think we identified.
Sure.
I mean, what good does that do us?
Well, I think for her anyway, it was an explanation as to why they decided to sit on their hands this time, and that our expectation is we'll probably see the rates rise in September and December. But the feeling was that because of the jobless report, because of the Brexit uncertainty, they just said, you know what, it's probably better to wait and see.
But Sam, Yellen's policy outlook seems to be swaying with almost every new news item that comes out. I mean, do you find the fact that she seems to be so highly data dependent, do you find that nerve-wracking or reassuring? Do you like the fact that she is being so data dependent in her policy decisions?
Well, I think it's interesting that it's almost as if we, the investors, are saying this is what Yellen should be doing, but then she doesn't do what we expect them to do because the data does not really point to that. So in a sense, she really hasn't changed her tune. It's just that the data does not support what they're looking to do. Today, if we were in a more normal economic relationship between Fed funds and inflation, Fed funds would be at 3.7%, not 0.37%,
right.
And that's where she wants to go.
So I want to get to this story in the Wall Street Journal this morning, A7 in the Wall Street Journal. Ahead of Brexit poll, big businesses are redoubling efforts for a Remain vote. What are these big businesses doing, Sam?
Well, redoubling, I think what they're doing is they're looking for opportunities in order to just stay within their marketplace. I'm not sure exactly what they mean by redoubling their efforts if the vote stays, but I think what it's implying is that they're not really looking to change their policies.
Right. Well, in terms of large businesses, Sam, if you look at the composition of the S&P 500, we've got our, U.S. investors seem to be very concerned about this vote and Britain staying in the EU, but such a small percentage of the revenue of S&P 500 companies comes out of Europe. Why are we overly concerned?
Well, I think we're overly concerned because the markets are so integrated. We're not decoupled. I think that we're more like mountain climbers tethered together. The U.S. might be the lead climber with solid footing and a firm grip, but should the other economies slip and fall, they're going to drag us with them. We estimate that about 46% of revenues for the 500 come from overseas, but only 7% comes from Europe. So it's really not that big of a deal when it comes to the U.S. activity.
So Sam, it looks like Remain is, in the polls, it looks like they're narrowly ahead. I was just in London on Thursday and Friday, and everyone that I spoke to, all of the taxi drivers, the workers, were telling me that they were voting Leave. So it's still a possibility. So what happens if Leave does win? What would happen to the markets then, and what will you do?
Well, I think that the concern would be that we do end up seeing a knee-jerk reaction. We do see a sell-off in global equities, but I think that investors typically are better off buying than they are bailing. It's very hard to get good earnings estimates for Europe, but right now we're looking at European valuations that are about 300 basis points below that of the S&P 500. We're also looking at dividend yields that are almost twice that of the S&P 500. So my feeling is it's not like Europe is going to go away. It's not like Britain is going to go away. So you would probably want to take advantage of that price weakness.
I just want to point out something, and part of the issue with people who want to to vote to leave. And these Britons, the level of fear-mongering going on among those who want Britain to stay, it feels a lot like the bailout in 2008. It feels a lot, you know, where they are trying to scare people into voting in the direction that they want, and people turn against that.
All right. By the way, what's your year-end target right now for S&P?
2175.
All right. All right, Sam Stovall, thank you for joining us this morning. Good to have you.
My pleasure.
All right.